Hello, everybody. I'm Ted Oakley. I'm managing partner of Oxbow Advisors, and I have the great pleasure today of interviewing Jesse Felder. I've followed Jesse for a long time. He had his own firm over 20 years ago, moved to Oregon, started his other business, which he is now doing his letter, and you'll see a lot of information about him streamed during this call, and I'd certainly recommend to you to take his service if you get a chance. He does podcasts, and I don't know anybody that's been interviewed any more than Jesse. I know he has some great thoughts, and so Jesse, welcome.
Well, thanks for the invitation, Ted.
I'm going to start out by the big question on everybody's mind today, which is inflation or no inflation. But you have one of the great charts you have is on long-term interest rates, and you see recently a small uptick. But do you see that continuing, or do you think that's just a flash in the pan?
Well, I think that's the real debate, right? I think we need to distinguish between short-term, cyclical inflation and longer-term secular inflation dynamics. I don't think there's any debate right now about cyclical inflation. I think everybody sees it. We hear businesses talking about it. We see supply chain disruption, and we've heard from Coca-Cola and a number of companies, Procter & Gamble, all talk about raising prices this year. So I don't think there's any debate whether we're seeing inflation right now and going to manifest on a cyclical basis. I think the debate is really about longer term inflation, and I do think we are the Fed wants us to believe that these inflation dynamics are going to be transitory. I think that's wishful thinking. I think probably we are seeing right now a shift from long-term secular disinflation to at least no longer disinflation, but probably over time, a shift towards secular inflationary trends. That doesn't mean inflation is going to go straight up in a straight line. I think what we're looking for is over the next number of years, the downtrend in inflation switching to an uptrend. So, this pattern of lower highs and lower lows kind of transitioning to a pattern of higher highs and higher lows in inflation dynamics.
And I think you mentioned that you've got a graph that shows some of the instabilities when rates went up going back to like 1985. And this last graph you shows a big move. And so I'm assuming you think that also could probably I'm asking this question, if you think that's going to cause some financial instability as well.
I think it's something to pay close attention to. It doesn't seem like interest rates have gone up very much, because we started 50 basis points on the 10-year yield roughly a year ago, and we haven't even really gone close to 2% yet. But historically, when you look at the rise in terms of a rate of change, whenever we've seen a 50% rise in interest rates and that rate of change, the 12-month rate of change, it's typically created some type of financial instability. And so, in that chart, you look back, the 1987 crash, part of what led into that was rising interest rates through the course of that year of 87. Again, in the 1994-5, we saw the Great Bond Massacre. The peak of the dot-com mania back in 2000 was also characterized by rising interest rates. And so the peak of the housing bubble, all of these things, the European sovereign debt crisis, they coincide with these periods of rising interest rates. And what I think it points to is when we have low interest rates, whether it's natural market dynamics or the Fed artificially pinning rates too low, it inspires a certain degree of leverage on the part of in the normal economy, the natural economy, and also in the markets. And so when those rates go back up, that leverage becomes problematic. And I think one of the manifestations we've seen already is this blowing up of the Huang family office, the Archegos family office, and obviously he had a massive amount of leverage. But when you look at things like margin debt and other things, there's signs out there that the amount of leverage in the markets right now is probably greater than anything we've ever seen. And so rising interest rates represent a direct threat to that leverage that's built up.
And you have two particular charts, Jesse, that are interesting, and its relation to business. And one is on business costs and inflation, and the other one, which is particularly germane to the stock market, or profit margins inflation. You might give me some thoughts on that.
Sure. Well, I think, one of the assumptions, I think a lot of people want to dismiss these valuation metrics like the Warren Buffett yardstick, which we'll probably talk about later, that show the stock market has never been as expensive as it is today. It's more overvalued than it's ever been in history. And people want to dismiss these kinds of indicators as to not being relevant for whatever reason into today's market. And so they look at more earnings-based measures, cash flow, which are still extremely high. You look at whether it's the Shiller-Cape ratio or forward PE ratios, we're still extremely high. But what I think people don't appreciate when you're using earnings-based valuation measures is that there's an embedded assumption that profit margins at record highs today, and have been over the last 10 years or so, will be sustained indefinitely into the future. Because if profit margins revert to historical norms, then earnings are going to come down, pretty significantly, and valuations will go way, way up. And that's one of the reasons why these non-earnings-based or profit price to sales-based valuation metrics, I believe, are more valuable, because they take the cyclicality of profit margins out of the equation. So today there's a couple different threats to margins that I think people are probably not appreciating. One is inflation is usually not great for corporate profit margins. It's one of the reasons why inflation's not good for financial assets in general, but stocks particularly. But even more importantly, I think corporate profit margins, these record highs in margins, have come at the expense of labor share. So labor has taken a smaller and smaller share of profits for the past 30, 40 years. And that's what's inflated corporate profits. But now we're seeing a real big pushback. Joe Biden has said he wants to be the most labor-friendly president in history. Another way of saying that is he wants to be the most anti-corporate president in history. And obviously, there are obvious reasons why he wouldn't want to frame it that way. But to the extent we're going to see a shift back towards labor that we're seeing through populist politics, that's a direct threat to corporate profit margins, which means valuations are much more extended than I think simple earnings-based valuation measures would suggest.
And Jesse, it had to catch up somewhere, because if you look at adjusted median family income over the last 20 years, it really hasn't gone anywhere at all, actually. And so it had to catch up eventually, don't you think?
Yeah, absolutely. And actually, back in 2001, kind of in the early days of the dot-com bust, Warren Buffett wrote about profit margins, and he said these record high profit margins at the time, which were slightly elevated, not even near as high as they were today, couldn't be sustained for any period of time without resulting in political problems. And so since that time, 20 years later, here we stand, and profit margins are much higher than when he wrote this. And I think what we're seeing are the quote unquote political problems that he foresaw, which is essentially labor saying we're not happy with stagnant incomes and all these things, and we are going to push back. We're going to vote for politicians that are going to be labor friendly. And I think Joe Biden heard that is his mandate, and he's going to push for that. And I think people don't appreciate what that means for corporate profits.
And Jesse, I think you would agree with me. If you look at Wall Street, if you look at buybacks, and when you look at where debt has gone to, so they've been able to really push a lot of debt out, buy stocks back, and you look at that, it really hasn't done anything for that average worker relative to the CEO. So eventually, that had to clash, I think, at some point, don't you think?
Absolutely, and I think that's why we're seeing, pushback against stock buybacks. But we're also seeing, I think, the number one threat to margins right now is, corporate tax rates. That's something that, Biden really wants to push through. And I think, the rest of the Democratic Party has said the first chance they get, they're going to roll back those Trump corporate tax cuts. And so, I think there's a number of ways, a number of threats to these record high profit margins.
So let me ask you this, and this is I'm asking you sort of what you think could happen. One of the things that's going on right now, and I do have one chart that we happen to put in that shows just the domestic securities, treasuries, T-notes and treasury bonds that were bought by the Fed in one of the past weeks. What it shows is that they're not only buying, people think they're buying like 0 to 3 years, 0 to 5 years. In effect, they're buying the whole yield curve, because you can go look at it on the New York Fed numbers every week. And I'm not certain people realize this, but let me ask you this. What happens if you go through a period, if your next 5, 10 years are a situation, or the next 5, where the Fed continues this yield curve control, they keep buying that paper, and yet at the same time, in the real world, like we're talking about here, you inflate, what happens?
Well, I think the Fed is playing a very dangerous game, and there was a great, I think it was an article in Project Syndicate or the Financial Times recently, where they make a terrific point, which was, a lot of inflation dynamics, or longer term inflation dynamics, are driven by expectations. And so it's inflation expectations that are important. And what Paul Volcker did that was so, I guess, important back, 40 years ago to break the back of inflation was he essentially told the world, I'm going to do whatever it takes to rein in inflation. And that really not just broke the back of inflation, it changed inflation expectations. It changed consumers' idea of where prices were headed, and gave the Fed a ton of credibility in that they're not going to allow inflation out of control. Now, we're seeing the exact opposite today, which is Jay Powell and the Fed saying we're going to do whatever it takes to create inflation and allow inflation to run hot. And so what they risk in this process, through all of these things like they're talking about, Ted, whether it's yield curve control and quantitative easing and holding zero interest rate policy for a number of years, they are risking these inflation expectations reversing once again from believing the Fed is going to keep inflation under control to believing that prices are now going to become untethered. And I think we're seeing that in a number of areas. Everybody knows, including my mom, that lumber prices are soaring. We're seeing costs of, cars and all kinds of things, prices in the real economy surging like they haven't done in decades. And that brings me to the money supply. You look at M2, the rate of the money supply growth is just, everything is pointing to inflation. And so the Fed risks in this, trying to maintain extraordinary monetary policy in the face of rising inflation is a shift in inflation expectations. And that could be the real risk to the economy over the next several years.
That's where the game really, really changes, because if something like that is going to happen, then I think you would agree with me, then the returns on financial assets have to be very, very low over that period if that's what happens.
Well, yeah, I mean, I think you have to talk about nominal returns versus real returns. Nominal returns from owning bonds could be, close to, whatever the yield is. But if they're pinning, let's say the 10-year yield 1.5%, wherever they choose to pin it, if they choose to do so, and I think they probably will, because the economy just can't afford higher rates, the government can't afford higher rates significantly. You'll get that 1.5%. But if inflation's running 3, 4, 5%, and I don't think CPI at 5% is out of the question over the next several months, then your real return from owning bonds is going to be horrendous over a 5 or 10 year period. And the same thing with stocks. If inflation is running high, those costs, I mean, every business is talking about it, right? Like right now in ways that they haven't complained about this, in decades. And so, profit margins for companies will be compressed. That's not great for corporate profits. And like I said, the real returns from owning bonds could be horrendous in that type of environment.
You know, last month we wrote a piece at Oxbow called There Is No 40, and you're familiar with the 60-40 Wall Street. And our point is that, hey, with rates where they are and inflation going up, there's no reason now to be thinking that 40 is going to be the offset it was the last 10 years. And to your point that you were talking about, that's really the problem going forward. If you have what we just talked about, effectively having yield curve control now, plus inflation picking up. So let's turn that to the stock market. And one of the things you talked about is the Warren Buffett yardstick. And for everybody out there that doesn't know, it basically is the total market cap of the market capitalization of the market to what we produce in GMP. So you might mention that a bit because it is really an extended graph you have.
Yeah, you know, so and one of the differences with my graph that I get asked a lot is why does mine show, you know, the market cap at 250% of the economy rather than 190% some others. So I'm not just looking at non-financial equities to the size of the economy. My graph represents non-financial and financial equities relative to the size of the economy. That's why it shows a higher reading than some others you might look at. But essentially, right now, the stock market, based on this metric, is 25, 30% more expensive today than it was at the peak of the dot-com mania, and even more expensive than it was at the 1929 stock market peak, significantly more expensive. And one of the reasons why I like this measure more than others is, like I said, it takes out the cyclicality of profit margins. Profit margins are historically, revert to their mean over, periods of time. So you have high profit margins make valuations look low, and vice versa. But when margins revert, those valuation measures become less valuable. So when you look at the 10-year return from owning stocks, there's a very high negative correlation to the Buffett yardstick. So I like to say, the price you pay is one of my favorite Buffett quotes. The price you pay determines your rate of return. And his measure that he wrote about, 20 years ago, this market cap to GNP, to me is the best visual representation of that. The price you pay determines your rate of return. You pay a high price, you get a low rate of return. You pay a cheap price, you get a terrific rate of return. And right now, because people are paying such unprecedentedly high prices for stocks, they'll necessarily, over the next 10 years, get probably the lowest annual returns over the average annual returns over the next 10 years that we've ever seen. And
I think you graphed that. You might mention, we have your graph about the forward 10-year returns, and on the red line, that actually goes into negative territory over that period. I think you graphed that out, showing that Buffett, exactly what you're talking about. It went back to 1949.
Yeah, it's pretty deeply into negative territory too. So I mean, it's right now suggesting that on average, buying essentially the S&P 500 today could generate a negative 5% plus return on average per year over the next 10 years. That's including dividends. So, nominally, without dividends, if let's say it's negative 5% and the dividend yields 1.5% today, you're looking at negative 6.5%, when you take out those dividends. And so yeah, it's all risk for no return essentially today in the stock market.
And one of the graphs you used some time back, and I thought it was really interesting because one of the things that's going on today, to have this conversation today with the S&P up this year and the whole thing, I'm in the same camp that you are, but the problem is that it's been so easy this whole period, this last 10 years, that you get people with the idea that, no, you just plug and play and everything will be okay in the long run. And so they've forgotten about the fact that you have to buy something at a certain value to get something out of it in the future. And one of the things you've got a valuation extreme graph that shows the components that are trading at 10 times sales, even relative to 2000, but you might talk about that.
Yeah, to me, this was there was a real poignant quote from Scott McNealy, who was CEO of Sun Microsystems, and at the peak of the dot-com mania, the stock traded over 10 times sales, and yeah, so he was interviewed about this. So the stock went up, tenfold, and then fell 90% plus over, in the bust. And he was interviewed about this in the wake of the dot-com bust. And he said, he asked, what were people thinking in buying and paying 10 times sales for my stock? It was such an extreme valuation. There was no way paying that price could generate a positive return for investors. And my point in bringing up this chart with showing the number of stocks trading over 10 times sales, it's significantly higher today than it was 20 years ago at the peak of the dot-com mania. So, investors are embracing extreme valuations to a degree and in a breadth that they've never done before in the markets.
It's interesting you mentioned Cisco too, because you've been around a while, you remember these numbers, but one of the things about Cisco, it's a good company, unquestionably, but 82 to 6 over a 3-year period, I think, or something along that line, and even not back to 82, Jesse, today. So it gives you an idea.
Yeah, even Intel's another good example, a company that didn't get incredibly overvalued like some of the other ones, but it got overvalued enough to where the price still hasn't overcome its 2000 peak when you take out dividends. 20 years of no returns, it's the price you pay determines your rate of return. You pay too much, doesn't matter how good of a company it is. You pay too much, and you're going to get terrible returns.
So let me move on to something that really I think is people don't realize today, and it's even much more so than it was in 07, 08, or even back in 2000, which is leverage. And leverage is hidden in a lot of ways now that people don't realize. And I think that's one of the things that people don't realize. Once you start to unwind leverage, you can really have some painful problems with it, and it comes quickly. And one of the things you have on here is margin debt to GDP and where that is right now as well. You might mention that, and because we have a lot of borrowed money against stocks right now.
Yeah, and when you study market history, to me, a margin debt is representative of a couple things. I love the John Kenneth Galbraith quote about it, which he said, even the most circumspect friend of the market would concede the volume of brokers' loans, essentially margin debt, is a good index of the volume of speculation. And so you look at this margin debt today, and so it tells us very clearly, no matter how you look at it, the volume of speculation is greater than anything we've seen at any point in time, really. And the other way I look at margin debt is potential supply and demand for equities in the market. So when you have margin debt that's very high, you have a lot of potential supply that could come to the market in terms of forced selling, because that's what happens when prices go down. Brokers, send out margin calls, and usually that results in forced selling. And so when we saw these really high peaks in 2000 and 2007 in margin debt, when the market rolled over, it created kind of a self-reinforcing downturn through the forced selling. And so, and vice versa, when margin debt is very low, that means there's a bunch of potential demand. There's a bunch of potential firepower for people to go buy. So today, looking at this, it just tells me there's an unprecedented amount of potential supply that could come to the market in the face of a downturn. I think this is one of the things the Fed recognizes, and it's why they've been so aggressive in trying to prop up the equity markets, because they realize once you start getting margin calls and forced selling, it's going to be very painful for the stock market.
And Jesse, one of the things that's not on that chart, though, and people, I wish I had a chart for it, but I don't, is in the last 10 years, all the Wall Street firms, especially when they're tied to banks, have basically set up security-based lending that does not show in the margin numbers. It's huge, though. That's where all the big loans go to. And it's all securities-based, though, in that, because they get a really great rate on it, and it goes from there. And then in addition, all of the leverage we see from the derivative market. And if you look at this year, just this year, if you look at Melvin and Greensill and Archegos, those are really big breaks. Long-term capital, what we put in, maybe it was $5 billion? It was nothing compared to these groups.
Yeah, and that's such a great point because margin debt is only representative of tons of other leverage that's, under the surface that we can't really quantify. And, we didn't have leveraged ETFs really, 20 years ago to any great extent. And today leveraged ETFs are extremely popular. And you make a great point with, derivatives. The options market has been a source of terrific leverage. The amount of retail interest in weekly call options that are far out of the money has just absolutely exploded this year. It's so much bigger than anything we've ever seen before in history, where you have, people, YOLO, you only live once, call options, where people are taking their entire account, and usually they're smaller accounts, but, we're talking $2,000, $3,000, $4,000, $5,000, putting it all into Tesla call options that, on today's Wednesday or Thursday, they expire Friday. They literally have 2 days before expiration, and it's, they're 20, 30, 40% out of the money. So these are essentially, lottery ticket type trades that create a ton of leverage and create, gamma squeezes in the underlying stocks that, are essentially another form of terrific leverage that's supporting the market today. And when that leverage goes away, it's just like margin debt. The floor below the market, falls away, and it could be pretty dramatic.
And it's interesting, for those investors, it's just exactly like being at the craps table in Vegas and you put it all on one throw. And, and it's a very, very, very high risk. So let me shift that a little bit because, if we're going to have even outside inflation, even if they keep yield curve controls on, that leaves us with some choices for individual investors that they're probably not used to making, which is hard assets. And I've got to grab one of your graphs on gold here, and I know you like gold, and we own some gold as well. But you might mention what direction that an individual investor, I'm talking about an institution here, might look at in terms of some protection against that next 5 or 10 year period that you see could come from some of the things we just discussed.
Well, yeah, you made a great point, Ted, about, the 60-40 portfolio and how, I think the major problem with the 60-40 portfolio is all the back tests you look, performance history, all those kinds of things go back no more than 40 years. And so they only encompass a disinflationary environment. And I think that's not helpful. You look at any of the greatest asset allocators who have put together long-term portfolio allocations that are based on much longer market history, 100 years, 150, 200 years of market history, and they all incorporate a significant allocation to hard assets, real assets, whatever you want to call them, because in an inflationary environment, financial assets, stocks and bonds, both do poorly at the same time. That diversification, that feels like I'm diversified today because I own a ton of stocks and a ton of bonds, that diversification goes away when disinflation changes to inflation, and both of those things go down together. And so to hedge against that type of risk, you need to have a significant allocation to real assets. Here we're talking about, things like tips, real estate, gold, commodities. And I think that the most tried and true, easiest to own is gold. And I think, that's why Ray Dalio has said, if you don't own gold, you don't know history. And I think, it's ironic to me that the fundamental case, macro case for owning gold is probably more bullish today than it's ever been in my lifetime. And gold is fallen dramatically out of favor again, as cryptocurrencies and these more speculative types of assets have become more popular. So, yeah, I do believe, not only is it smart to have an allocation to gold probably at all times, but especially it's important today facing, the environment that we're looking at over the next several years.
Well, in the decline of our fiat currency goes into that, and you mentioned that gold has faded a bit in here over the last few months, and probably because of cryptocurrencies. For people on the outside, they really normally think about Bitcoin or Ethereum or something like that. But now we have many, many more. And I won't discuss this with you a long time, but if anybody out there has an interest, and I know we have a number of investors that really don't understand the cryptocurrencies and the Bitcoins of the world, you'll see a streamer here where you can send us an email and we'd be happy to send you a report that outlines what it is, just so you know. It's not a pro or con, it just tells you what it is. But on that note, Jesse, it looks as though in their effort to try to have something that the Fed doesn't control, which started years ago, that we've now turned that whole Bitcoin cryptocurrency situation, Coinbase, into something that is actually a speculative mania instead of what sort of it was beginning to start with in the start. Any thoughts on that?
Yeah, I really do sympathize with cryptocurrency aficionados. I think the creation of them and the inspiration behind them was absolutely valid. It's we want a way to escape this fiat currency debasement that's just perpetual thing in history and is potentially accelerating right now. What I don't, I guess, buy into in the cryptocurrency world is the scarcity argument. I think that what makes real assets, hard assets, valuable is their true scarcity. There's a limited amount of real estate, on the planet. There's a limited amount of precious metals on the planet. We can't create more of it. Cryptocurrency claims that it's limited in supply, but there is no limit to the number of cryptocurrencies that can be created. And so we have not just Bitcoin, we have Ethereum, and we have Ripple, and we have Dogecoin, and we have all of these other things that, I think ultimately what cryptocurrency hasn't solved for is human nature. And when the demand for something, grows so great, there is a real, tendency to create supply to meet that demand. And that's what's valuable about hard assets. You can't create more supply. So they're effective in hedging in those types of environments. What we're seeing today in crypto is because the demand is so extreme that we're seeing tons of new supply coming into the markets. And so to me, that right there immediately negates its argument, the scarcity argument. And to me, that is probably the biggest problem that I have with cryptocurrency.
And we've been in our own portfolios, but telling investors as well, in order to offset all of this, you have to have some gold, you have to have some energy, you have to have some real estate, and even real estate would be if rates tended to push a little bit, it creates a less supply of real estate as well. And I think people today are investing. I was around when you had inflation and when real assets, they were really going up a lot, and they'd go up every other month almost. But now you've been in a situation where if you look at the average portfolio manager at 48 years old, they've never seen that. They don't have an idea of what that looks like, and I think that could be the real shocker for them over the next 10 years. What do you think?
Yeah, no, I absolutely agree. And I think, if you look at the average investor, is probably 30 years old today. They weren't even, investing during the financial crisis. So they've literally never even seen a bear market before, let alone, what my greatest fear is that there have been times throughout market history, whether it's here in the United States after the 1929 peak or in Japan after the 1990 peak, when you have these mass speculative bubbles, it can leave in its wake a very long, extended period of time of no returns. You look at Japan after 1990, and the Nikkei is still dramatically below that peak that it set 30 years ago. The late 60s peak in the stock market, it wasn't until the early 80s, mid 80s, that peak was taken out. And so I think what a lot of people don't appreciate today is that's generally how the way these things resolve is that prices don't necessarily crash, but you have an extended period of time, a lost decade, potentially a lost 2 or 3 decades, which would be pretty disheartening to a lot of people expecting to generate 10, 15, 20% returns from equities in perpetuity.
And even 2000 to 2012, it was this, if you came in at the wrong time, and people always, they tend to say, hey, it doesn't make any difference when you begin. It's our opinion, it does make a difference when you start, because where prices are. But let me ask you one last question, and then this is something that we notice at Oxbow, but we notice on the outside too with investors we know. And the only other time I saw this was late 1999, and that was where we would see the most conservative investors we knew, that they wanted to be really close to the vest, take very little risk, that sort of thing. But after a few years of markets moving and them going to cocktail parties or whatever and seeing people make a ton of money, they couldn't take it. And all of a sudden they started doing some really speculative things that are out of nature. It's not their nature to do that. And we're starting to see that again today. We just started seeing it in the last 3 to 4 months, 5 months. Do you notice that?
Absolutely. Well, another one of my favorite quotes, I think, comes from J.P. Morgan, is there's nothing so undermines your judgment as seeing your neighbor get rich. And I think that's what we're seeing today is whether you're seeing it on social media, it's young people on TikTok are seeing that their friends bought Dogecoin and made 1,000% return, and it's pulling, they feel like they're envious and they're missing out, and so there's this fear of missing out. But it's on every level, whether it's in the real estate market today and people thinking, I have to buy a home today or maybe I'll never be able to get into the market. And so they'll pay a price that is obscene. But it's in cryptocurrencies, it's in stocks, it's in everything. And so I do think, yes, you're absolutely right, Ted, and it's interesting for me to hear your anecdotal perspective too from what you're seeing, because it's exactly what I'm seeing too, which is a level of risk taking among every type of investor that is obscene. And these episodes never fail to end badly. And so I hope some people watching this at least are able to resist that temptation and realize that yes, their neighbors might be getting rich, but a lot of those profits will remain virtual.
Right. Well, and unfortunately, all of this really hurts the person that was raised as a young person by a family and said, hey, always save some money, save some money, save some money. But you know what? During these kinds of periods and the periods we have ahead, that's who it will hurt the very, very most.
Yeah, absolutely.
So, Jesse, great interview. As always, we really appreciate it. We were fortunate to have you come on today. And for everyone, we put up a couple of times. You're seeing it here. If you want to take Jesse's services, I would certainly encourage it. He has some of the most interesting viewpoints of anybody you'll ever see. But Jesse, thanks a lot. We hope to see you again.
Thank you, Ted. It was a pleasure.